So welcome back to another video. Today I'll be explaining the basics of options trading. I'm going to be showing you how to buy a call option, what everything means, and hopefully clarify some stuff for all the beginners out there. I'm going to be showing you on the Robinhood platform. I don't necessarily recommend trading options on Robinhood, although I know a lot of people do use Robinhood, especially the viewers. And I mean, it's not awful, but I don't know, just take that with a grain of salt. So on screen, I have pulled up the Apple options trade grid, and as you can see, I have selected to buy a call option, bullish on the underlying security. When you buy a put, that means you are bearish, or you think the stock's going to go down. So next to that is the expiration. So the expiration date is when your option will expire, hence being an expiration date. So what is an option? An option is basically an agreement between two traders to buy 100 shares of a security at a specific price by a specific. I was telling you, I want to buy 100 shares, aka one contract, because all options trade in contracts, which is 100 shares. It's as if I'm telling you, I want to buy 100 shares from you at $137 a piece by March 5th. So it's just like you and I. And then if you agree to that, that means by March 5th, if the price is, no matter what the price is, technically I can exercise that and I can buy it from you, which could be good for you and can be bad for you, because if the price goes above that, that means you're selling to me at $137, and let's say the price is $150, that means I'm making money and you're losing money. Whereas as if the other person wins, meaning the price might stay the same or even goes lower, that means that I essentially pay you to take the other side of the option, and then I get nothing and I lose what I paid you, and I get zero out of it, and you get to pocket that, which we'll get on that on another side, because that's two sides of the option. That's buying a call and selling a put, but I'm going to be talking about buying a call today. So as you can see, Apple is ended the day at $135 per share. I'm recording this on February 2nd, after hours, so just whenever you're watching this, kind of put yourself in that timeline. So any of these strike prices that are above the current trading price, which is $135, is called, anything above is called out of the money. The market price, such as $135, is called at the money. And then anything below is called in the money. When you're buying calls, you normally want to be in the money. There's a couple strategies where you can still profit, but buying a call like this, you want to be in the money. That is where you're making profit, which, that's good. Everybody likes money. So what are all these numbers? Please explain them, because there's a lot of numbers and I don't understand it. A lot of colors, blah, blah, blah. So the strike price is basically, it's the agreed upon share price that you are writing this agreement to. So let's say I pick the $137 strike price, expiring March 5th, about a month out, and it's going to cost me $4.43. That is a little misleading, because it'll actually cost you $443, because again, we're trading in contracts, which is 100 shares, so you have to multiply that by 100, because it's $4.43 per share times 100, 443. So let me click on that. As you can see, it'll bring you all this stuff. I'm going to type in one contract, and then this is basically like your fill price. You can kind of dibble and dabble around with this, but typically I just go straight for the middle, and it'll kind of default you to that. Well, I didn't actually purchase it, but I have agreed upon paying $445 for my side of the agreement to buy Apple on March 5th at an agreed upon $137. Easy enough. So that's an out of the money option. Now, how do I make money from that? I have to have the share price go above my $137, right? But that's not all, because yes, I understand that I can buy the shares at $137, but you also have to remember the premium that I purchased the option with. So that means that to actually start to make money, the share price has to be $141.43. How do I get that number? It's the strike price plus the premium that I paid to have the option written up and agreed upon and such. And yeah. So the expiration date, how does that affect the option? The farther out you go into the future, the more expensive the option is. Why is that? It's because you are given more time for that option to be thrown deeper into the money, meaning you have a higher likelihood that you will profit. And then as you go closer, it's cheaper because there's a less likelihood that your option will be thrown into the money. So I'm just going to click this. This expires in about 2-3 days. The likelihood that Apple will close in a couple days at $137 is a lot less likely. Hence, you only pay $92 for this option. Whereas if I bring this out for a month, the same option, but expiring in a month, is $443 because you are entailing more risk in the short term because it has to get above that in the next couple of days. And if it doesn't, you're losing. There's a ton of numbers here, and I'm not going to get into all of them, but I just want to touch upon a couple of them. 1, open interest. This is how many options are being traded at this price. So this is going to change at the different strike prices. As you can see, when I go up to 138, it's about the same, but they change a little bit depending upon how popular the option is. Now, what are these things? The Greeks. No worries, you can speak English and you can still understand them. So the delta is basically for every dollar that the underlying security moves, that is how much your option will move. So if Apple goes up $1, your option will go up $32 or 32 cents per share. Going to skip gamma. I'm going to go straight to theta. Theta, what is that? Theta is implied volatility and time decay. So again, time is very important in these options because as time slowly dwindles down, there's a less likelihood that you will become profitable. And you actually lose value throughout time because of that. Theta is that rate. So this option will lose 26 cents per share, $26 per day. That is so high because it's so close. So theta is not a linear graph, meaning that it's not constant. So when it's far out, it'll go slow, but then when it gets closer and closer, it's exponential, and then it'll really start eating away at your option. $7 call option is going to be a lot less at about 8 cents per share, or $8. And then if I draw this way out to September, well, you don't have the $137 strike price, but now you're at 3 cents per share at the 140 strike price. So I'm going to go back to about a month out. Implied volatility is also very important because the implied volatility is essentially how much the underlying security will move. With a higher implied volatility, there's a higher likelihood that your option will be swung into the money. With a lower implied volatility, that means that there's a less likelihood that your option will move and throw you deeper into the money or in the money. And now implied volatility, there is no like, oh, 70% or 30% is high or low. It is really dependent on the specific security. So something like Apple will have a different implied volatility than something that is highly volatile, something like one of the EV stocks like Tesla or NIO. Please pay attention to this when you are buying options because you should be buying when the implied volatility is lower because the graph on implied volatility is kind of like a stock chart, except it's more sideways than trending upwards or downwards. And it will go above and below the median, but it will always like revert back to the median. So if you buy it at a high implied volatility will eventually come back down and you will lose value in your options trade. Now, I would like to mention with options, one of the nice things is that you do have a limited risk and you do have an unlimited reward with buying call options, because you cannot lose more than you put in. So if I do buy this call option, the $445 that I will be spending, I can't lose any more than that. That I just lose it if I lose it. But if theoretically the stock price can infinitely go up, and if it does, I consistently make profit, which is good. Now, here's a nifty little helper, especially with beginners, for options trading, because it gives you a nice visual on your options trade. It's called Options Profit Calculator. So just the basic long call bullish is what we've been talking about. So you'll click that. So you'll just fill out the information, such as the ticker symbol. It'll automatically get the stock price. So you'll just get your expiration, which we have March 5th. And we'll select on the left, which is calls, what we've been talking about. And we'll go down to the 137 call option. And now it shows us this grid. And this is amazing because this is where a lot of people get the aha moment with options. And so $135 is the current share price. Now, as you can see, if you trace this all the way to the expiration date of March 5th, notice how you lose 100% of your value if the share price is at 135. That's because theta will eventually eat the entire option up. And it'll show you how much you'll lose throughout the time. So the white is basically like your breaking even, and again, as we saw that the break-even price was $141. $141, as we come up here, drag it out to the expiration date, that's where we're breaking even. We're making about 5% on our option, and anything above that, then we're making money. So let's say it goes up to $145, we're making 88%, which is a very profitable trade. But this is where you begin to see everything, and of course, as the share price goes down, you are going to lose a ton of money as well. So definitely recommend using that kind of to get a visual on your trades, see how much it does have to go up just to break a profit, and how much you can be risking if it really gets screwed up. Now, there is one last thing that I do want to touch upon. When you do buy a call option and you want to sell it, you don't actually have to wait till the expiration. You can sell your half of the agreement to another person who sees that there's still more value in that option. Let's say you did buy this 137 call option and it's at 443. Now, if this share price jumps up tomorrow to like 136, this will become a larger number, the premium, so that might jump for 75, for 80, and then you can actually sell your end of the option to the market or to another person and then take the 40 cents in between, or the $40 profit. When you do want to sell your option, you're not going to come back here and press sell. Do not do that. That is writing up another option. You'll actually see it just in your portfolio. It'll say like Apple call option 137 blah blah blah. You click on that, you're going to scroll down and it's going to say as your sell. That is how you sell your option, not through the actual options grid. Now, if you made it this far in the video, one, I'm actually very shocked because this stuff can be boring, and number two, congrats to you, because at least you show the signs that you want to learn options, and that's the first step to being a profitable trader. I'd really appreciate it if you could drop a like on this video. It helps out my small channel a lot, and sub. And don't forget that bell notification so you can see the other options tutorials that I'll be dropping soon. But until then, see you later, and good luck with all your trades.